Hey everyone, and welcome. Today we're going to break down the entire CPF retirement journey. It can seem pretty complex, but our goal here is to turn it all into a simple, clear roadmap, one that takes you from your first paycheck right through to a lifetime of payouts.
So here's the big question, right? How does CPF actually take all those savings you've built up over decades and magically turn them into a steady salary, one that you literally can't outlive? That is exactly what we are going to unpack today. We'll look at that huge milestone at age 55, get into the nitty-gritty of how CPF Life works, and talk about the really important choices you get to make.
Okay, let's get into it. For our roadmap, there are 3 key ages you really need to remember. First, age 55. That's when your retirement savings all come together. Then there's age 65, which is the earliest you can start getting those payouts. And finally, age 70, the absolute latest you can hold off. Just keep these 3 numbers in your head as we go through this.
First up, let's talk about the big one, turning 55. Seriously, this is a huge turning point in your entire CPF journey. It's the moment the whole system kind of shifts gears and starts getting everything ready for your retirement.
So what actually happens? Well, the moment you turn 55, a brand new account is created for you. It's called the retirement account, or RA. To fund it, CPF automatically moves money over from your special account first, and if that's not enough to hit your retirement sum, it'll then draw from your ordinary account.
And get this, that money doesn't just sit there. Your savings in your new retirement account keep working for you, earning a pretty fantastic risk-free interest rate of up to 6% per year. This is how your nest egg keeps growing, even after you've stopped working.
Now, I mentioned the retirement sum. You've probably heard this term thrown around, the full retirement sum, or FRS. You can think of this as the main goalpost. It's the standard amount that CPF helps you set aside at 55, and hitting this target is really the key to getting that steady, lifelong monthly income.
So let's put some real numbers to this. For someone turning 55 in 2025, you've got 3 main tiers. The basic retirement sum, or BRS, gets you around $930 a month. The full retirement sum, which is the default, nearly doubles that to about $1,730. But if you're able to top up to the enhanced retirement sum, you could be looking at over $3,300 a month. It's pretty straightforward. The more you have in your RA, the bigger that monthly retirement salary will be for the rest of your life.
But it's not all locked away, which is great. At 55, you get some real flexibility. First, you can take out up to $5,000, no questions asked, no strings attached. If you've managed to save more than your full retirement sum, you can take out every dollar above that amount. And if you own a property, you can pledge it, which lets you set aside the lower basic sum and withdraw even more cash.
All right, so you've hit 55, and your retirement account is all set up. So, what happens next? This is where we get to the real engine of your retirement income, a little something called CPF Life. So what is CPF Life? In a nutshell, it's Singapore's national annuity scheme. But what does that actually mean for you? It means a monthly paycheck that comes in month after month for as long as you live. It's designed to protect you from the very real risk of running out of money, and that offers some serious peace of mind. And the best part? For most of us, this is totally automatic. If you were born in 1958 or later, and you've got at least $60,000 in your retirement account when it's time to start payouts, you're in. You don't have to do a thing. This covers almost everyone, making that lifelong income a default safety net.
But automatic doesn't mean you have no say. You still get to choose between 3 different CPF Life plans. The standard plan is the default. It gives you higher level payouts for life. The basic plan gives you a bit less each month, but leaves more behind for your family. And then there's the escalating plan. Think of this as your inflation fighter. It starts lower, but your payout actually grows by 2% every single year. So your choice really boils down to what's most important to you. More cash now, more for your loved ones, or protecting your buying power down the road.
Okay, let's fast forward a bit. You're approaching age 65, and this is where you get back in the driver's seat. It's time to make some key decisions about your payouts. So when does the money actually start flowing into your bank account? Well, your official payout eligibility age is 65, but you actually have a 5-year window of flexibility. You can decide to turn on that tap of lifelong income anytime you want between ages 65 and 70.
Now here's where it gets really interesting. There is a huge incentive to wait if you can. For every single year you delay starting your payouts, your monthly amount goes up by up to 7%. So, if you wait all the way until you're 70, you could be looking at a much bigger check every single month for the rest of your life.
And the flexibility doesn't stop there.
At 65, you also have a one-time option to withdraw a lump sum of up to 20% of whatever is in your retirement account. This could be super useful for a big-ticket item or just to have extra cash on hand. Just remember, taking this will mean your monthly payouts will be a bit smaller.
All right, we've talked a lot about how the system works automatically, but what if you want to do more? What if you want to take things into your own hands and really supercharge your retirement? Well, you can. Let's look at how you can proactively boost those future payouts.
I think the most important thing to remember here is that you're not just a passenger on this journey. You can absolutely get in the driver's seat and actively grow your retirement savings yourself through voluntary cash top-ups. It's all about giving you more control.
And the #1 tool for this is the Retirement Sum Topping Up Scheme, or RSTU. It's pretty powerful. You can add cash to your own retirement savings, or you can even top up for your loved ones, like your parents or spouse. That money then gets to compound at those high CPF interest rates, and this is a big one, you get annual tax relief for doing it.
You heard me mention tax relief, right? So how much are we talking about? We're talking up to $8,000 in tax relief every year just for topping up your own CPF account. That's a direct reduction in the amount of income you pay taxes on. It's a fantastic deal.
And you know, there's also a fantastic scheme for those who might need a bit of a helping hand. It's called the Matched Retirement Savings Scheme, or MRSS, and it's specifically designed to help eligible seniors with lower savings build up their retirement nest egg way faster.
This is where it gets amazing. Under this scheme, the government will literally match every single dollar you top up, one for one, up to $2,000 a year. That's an instant 100% return on your money. It's an incredibly powerful way to help yourself or your parents catch up.
So, let's just bring it all home. Understanding this roadmap, from the creation of your RA at 55, to the different CPF life plans, to the powerful option of topping up your savings, that knowledge is what empowers you to plan effectively for a secure and really comfortable tomorrow. And that really brings us to our final thought. We've walked through the whole journey, all the milestones, and all the choices you have. So the real question is this. Now that you know your options, what is the one choice, big or small, that you're going to make today to help out your future self?